And let's face it, Australian Canadian companies, I don't value very many because most of them are incredibly boring. The stories
Yeah,
being
yeah, yeah.
told, right? You take BHP. Where are you going to go with this story, right? We
Mm,
can
mm.
talk about how climate change can be an existential crisis to your story. And that actually is something interesting because you can't just project out the way people used to value commodity companies was take the pricing cycle, average it out, and normalize the price, right? Oil price will always return to $51 a barrel. We'll value it on that basis. That works if your cycle reverts back to the way it used to be. And the way I think about valuing oil companies today is with climate change and the threat, the potential that fossil fuels will become a smaller part of our energy requirements. When I value an oil company, I can't just assume reversion to the past, normalization. That has to now become part of my story, which means the more you think fossil fuels will be curtailed, the less likely you will be to buy ExxonMobil. That's the way stories go. Your story is going to drive your valuation, and I think we need to make it more explicit.
Yeah. So now I guess we want to get to some of the different levers of valuation. You write about the four levers of valuation being revenue growth, operating margins, reinvestment, and then risk. So can you talk us through how those four elements come together?
I'm actually going to step back from the actual metrics. Okay? Growth is obviously the first one. Why am I looking at revenue growth as opposed to earnings growth? Because the only measure of growth that actually captures true growth is revenue growth. You can grow your earnings as a mature company by cutting costs. So I want to get a sense of how big is your market, how much are you growing. So revenue growth becomes my proxy for the growth in your business. My second measure is profitability. I'd like you to be in a profitable business. The way I'm going to measure profitability is with operating margins, not net margins. Because again, you can take a profitable business, if you borrow enough money, make its net margins low. So I want to look at the operating profitability of your business. The third is the dark side of growth. I mean, if you ask companies, do you want to grow a lot or not grow at all? Every company is going to say, I want to grow a lot. You're an airline. You want to grow a lot. What do you have to do? You got to spend a ton of money. In fact, I don't think it makes sense for you to grow because by the time you're done, what you've spent, you're never going to get back. So the reinvestment is really the sobering side of growth. It's what I used to tell managers, hey, you want to grow, but are you willing to reinvest this much? Because this might mean you'll never pay a dividend. You might have to issue fresh equity. If they say, look, I don't want to do that, then I say, okay, well, you got to go back and look at your growth story because you need reinvestment and growth to be consistent. The story you're saying has to be the same. As for risk, I think in finance we've made the mistake of making it a number, a metric, a beta, a cost. Ultimately, risk, there's two components of risk that show up in evaluation. One is your operating risk as a company. The ups and downs that come from being a cyclical commodity company, a company that sells discretionary products. That's what we capture in our discount rate, operating risk. But there's another risk we don't even talk about, partly because it makes us uncomfortable, which is the risk you will not make it. Two-thirds of startups don't make it. If you ask me to value a startup, I need to bring that in explicitly. You'd be surprised. Venture capitalists don't do this. I think that venture capitalists try to push this all into a target rate. I want to make a 50% return when in fact the bulk of the risk you're worrying about is will this business make it? So I'll divide risk into two components, an operating risk that shows up at the discount rate and a truncation risk, which can come from, it can come from distress that you will not make it, you run out of cash. Just last week I wrote a piece on catastrophe risk, and it was precipitated by an email I got from a reader in Iceland who said, I'm looking at this company called Blue Lagoon. It's an Icelandic spa, a very profitable, established spa, you know, but it's right below a volcano that's erupting in Iceland right now, and the lava is moving down, and there's a chance, a real chance, not just tiny chance, that this power will not just be threatened but wiped out. He said, how do I bring that into valuation? You can't do it by raising the discount rate. This is an existential risk. The way you have to bring it in is you have to assess the likelihood that the volcano will continue to erupt, the likelihood that the lava will flow in the direction. You're saying, how the heck am I going to do that? There's no way around it, right? Uncertainty is uncertainty. This is part of what I said. People think that valuation can solve the problems of life. I can't build an Excel spreadsheet that removes the risk of a volcanic eruption. All I can do is be realistic about assessing it. So think about risk on both levels, operating risk and truncation risk. And those are the components that drive value. A discounted cash flow value is just a vehicle for bringing all of those things together into one. So when I look at a discounted cash flow valuation, I don't see cash flows and discount rates. I see a story about growth and margins and reinvestment and risk. And the question I'm asking is, am I okay with this story?
So conceptually, we're covering off a number of the building blocks here. Understanding the difference between price and value, understand what you're doing, and then understanding the roles that numbers and narratives play in evaluation. Then some of the key levers of valuation that we've just covered off. And then finally, we thought an important concept to cover off is the probabilistic margin of safety. Now, Bryce and I are both big fans of Seth Klarman's book, Margin of Safety. It's probably one of my favorite investing books. And you've taken that concept and then added your own twist to that with the probabilistic margin of safety. So can you tell us about that?
See, to me, it doesn't show up as a margin of safety. It shows up as an expected value. Let's say I value the Blue Lagoon at $1 billion without the volcanic eruption. Let's say there's a 30% chance that the volcanic eruption will deliver lava in my way. And remember, it's too late to go out and try to buy insurance now, right? Maybe 20 years ago you could have, but there's no insurance company in the world that's going to sell you insurance against an eruption that's already in place. So if this eruption happens and 30% of chance of lava coming down, the value of Blue Lagoon is going to be zero, right? It's not even that you can sell the land. What are you going to sell? The lava is going to have a life of several years before it cools down. You can do anything. So I've got a discounted cash flow valuation with a going concern of $1 billion, the 70% chance of that happening, and it's a value of zero, the 30% chance. When I'm done, I have an expected value of 700 million. There's no margin of safety needed on this. It's already incorporated. So when people talk about margin of safety, I love Seth's work. Remember, it's a post-valuation component you bring in because you think you could be wrong on your assessment of value. This has nothing to do with risk or cash flows. So this has nothing to do with the company. This has to do with you, which is if you're risk averse, you value the company, say, I don't know whether I got that right. One of the ways you try to deal with that is by saying, I could be wrong, so I'm going to need the value to be at least 30% higher. But be careful. If you do that, I don't know whether you remember in statistics, there are two types of errors you can make, type 1 errors and type 2 errors. So if you convert that to valuation, by putting a large margin of safety, what are you doing? You're avoiding buying something that's overvalued simply because you screwed up in the value. So you're avoiding type 1 errors, but you're creating type 2 errors, which is you're also avoiding buying things that are undervalued because you put a margin of safety. Which is going to be greater? It depends. I would argue that in the world we live in, you can't afford to have a margin of safety.
Interesting.
If you have a margin of safety, you're going to be all cash. In fact, one of the questions I ask people, they say, I have a big margin of safety, is I ask them, what percentage of your portfolio is in cash? And they say 60%. And my response is, your margin of safety is too high. If you have that much cash, you essentially don't have the luxury to turn away investments. Maybe in Seth's time, he had hundreds of potential investments that were cheap and he could pick only 20. You can afford to have a margin of safety. No. But beggars can't be choosers. We are in a world where it's tough to impose a large margin of safety and get away. And there's a flip side of that. I recently bought Tesla at the time that the price approached value. People were surprised. They said it's a risky company. And if it's just fairly valued, why would you buy it? Because I think there is the flip side of margin of safety, which is what I call optionality. What's the optionality with you do a valuation of a company, you base it on what you think the company can do with its existing assets and business model. What you're missing is whether that business model gives you a launching pad to do other things in the future. I bought Facebook when it got close to fairly valued. Again, the reason is you have a platform with 3 billion people. My valuation was built on advertising revenues, but if you have 3 billion people spending an hour every day on your platform, think of the other stuff you might be able to do with them. That's like icing on the cake. So when I buy at fair value, if they can pull off any of that stuff, it's added value to me. So I would actually flip this on its head. There are some companies we actually should be buying as soon as the price hits the value, because there's so much good stuff you haven't built into your intrinsic valuation.
Yeah, I love that.